Hello friends, welcome to our YouTube channel, The Learning CA, where we share information regarding corporate tax provisions regularly. Today in this video we will be discussing certain key tax and regulatory aspects which are to be considered before undertaking cross-border transactions. Hope you enjoy learning, and if you find this useful, please like and share this with your friends. So friends, first and foremost aspect is exchange controls and regulations. Some countries have exchange controls in place that restrict or regulate the movement of foreign currency. Hence, it is important to understand the exchange control regulations in the relevant jurisdictions and ensure compliance. Friends, in case you are entering into a joint venture with other promoters or funding the overseas entity, it is essential that a due diligence is conducted to identify potential risks and liabilities associated with the proposed transaction. That means you should conduct the due diligence on the target company or assets, including legal, financial, and tax due diligence. Friends, it is also essential that valuation analysis is also undertaken for transactions involving equity infusion. Cross-border transactions require a thorough valuation of the target company or assets, and it is also important to consider the appropriate valuation methodology and prospective market as also tax regulations in the relevant jurisdictions to arrive at an appropriate valuation. Cross-border transactions may involve the repatriation of funds to the home country. It is important to consider the tax implications of repatriation and develop a strategy to optimize tax costs. The most important thing to analyze is also to know the tax implications which arises in both the home country and the host country. It is important to understand the tax implications and plan the proposed transaction structure accordingly. Friends, apart from jurisdictional taxation, an assessment from OECD MLI perspective is also required to be undertaken. The OECD MLI is a multilateral treaty developed by the OECD to implement certain measures of the BEPS project. It aims to prevent the avoidance of tax treaties and improve the resolution of tax treaty disputes. It is important to consider the provisions of the relevant tax treaties and the impact of the OECD MLI on the proposed transaction. And finally, if the transaction is going to be undertaken between related parties, then a thorough analysis from transfer pricing perspective is also required to be undertaken. The transfer pricing analysis involves analyzing the transaction between related parties. Conducting a transfer pricing analysis and ensuring that the transaction is priced at arm's length helps to ensure compliance with relevant tax regulations. So friends, this is all for today. Hope you have learned something from this video. Please do like and subscribe our YouTube channel, The Learning CA, a hub to enhance your tax knowledge.